Hello and welcome back to my YouTube channel where I upload tutorials on quantitative finance and derivatives, usually in short bite-sized format to help people understand important financial topics. Today we're going to learn all about CDS or credit default swaps, why they exist, what they are used for and how they are structured. This is video 3 in my series on credit derivatives. If you want to watch the whole series, a link to the playlist is provided above. Okay, so firstly let's answer the question, what are credit default swaps? Blythe Masters, who you can see on screen right now, is widely credited with creating the modern credit default swap when she worked at JP Morgan. She became a managing director at the age of 28, the youngest woman to achieve that status in the firm's history. In 1994, JP Morgan had extended a $4.8 billion credit line to Exxon, which faced the threat of $5 billion in punitive damages for the Exxon Valdez oil spill. A team of JP Morgan bankers, led by Masters, then purchased protection against the credit line to cut the capital which JP Morgan was required to hold against Exxon's default, thus reducing its own risk. Masters' idea was based on the idea of a swap, a derivative I've explained in an earlier video. Instead of swapping bonds or currency or interest rates, her idea was to swap the risk of default. In effect, JP Morgan could sell the risk that a borrower won't be able to pay back their debt. Since banking is based on making loans to customers, the risk of default by those customers is a crucial part of the business. A product that made it possible to reduce that risk by selling it to somebody else had the potential to create a gigantic new market, which it did. Credit default swaps are legal contracts that provide insurance against the risk of default by a company or country on its bonds. It's a swap agreement that the seller of the CDS will compensate the buyer in the event of a loan default or other credit event. The CDS buyer makes a series of payments known as the CDS fee or spread to the seller, and in exchange receives a payoff if the loan defaults. CDS are the most widely traded credit derivatives today. Swap sellers promise swap buyers a big payment if an entity's bonds or loans default. In return, they receive quarterly payments. Neither needs to hold the underlying debt when entering into a CDS transaction. CDS are similar to other swaps in that they are valued at zero at inception and later may incur gains or losses depending on changes in the credit markets. A company or country can be the underlying entity on which the contract or derivative is based, and these are called the reference entity in the CDS market. A default by the reference entity is called a credit event. The buyer of the insurance has the right to sell the bonds issued by the reference entity for full face value when a credit event occurs. The CDS insurance seller has the obligation to buy the bonds for full face value when a credit event occurs. The total face value is the swap's notional value. The buyer makes periodic payments to the seller until the maturity of the CDS contract or until a credit event occurs, typically quarterly or half-yearly. Settlement can involve physical delivery of the bonds or a cash settlement. A CDS contract typically references the credit derivatives definitions as published by the International Swaps and Derivatives Association, or ISDA. The confirmation typically specifies a reference entity that generally, although not always, has debt outstanding, and a reference obligation, usually an unsubordinated corporate bond or government bond. The life of the contract is specified by the effective date and termination date. A CDS contract usually specifies that a number of different bonds issued by the reference entity can be delivered in the case of default. Usually these bonds will be of similar seniority, but they may trade at different prices after default. Should this occur, the buyer of CDS protection will search for the cheapest to deliver bond, which they deliver to the CDS seller in exchange for the insurance-like payout from the CDS contract in the event of the reference entity's default. Many large financial institutions make markets in CDS on companies that they may never have lent any money to in the past. CDS market makers will then stand ready to buy or sell protection and earn a spread between the two prices. Market makers can hedge their exposures by trading in the underlying bonds, if needed. Most CDS contracts are 5 years in duration, but can be traded in other maturities. Banks are large buyers of credit protection to hedge their loan books, and insurance companies are the biggest sellers of CDS. There are several events that can constitute a credit event and necessitate a payout on a CDS contract, including bankruptcy, failure to pay either coupons or principal payments, or restructurings. The legal documents supporting the CDS contracts are very lengthy, and potential investors would be wise to read carefully the definitions of specifically which corporate actions or events will be classified as credit events and legally entitle them to the payouts. The CDS spread refers to the price paid annually for protection on the bonds. This can also be compared to the spread over a risk-free rate at which the underlying reference entity's bonds trade. These should be very close, otherwise there would be arbitrage opportunities. Typically, when a company goes bankrupt, there is some recovery for the bondholders from liquidation of the firm's assets, usually expressed as a percentage of face value, and typically estimated to be 30 to 40% of the face value of the bonds. That's just based on historical bankruptcy payouts. Each case, of course, is unique. CDS buyers receive the notional minus the recovery in a credit event. CDS can be used to hedge a regular portfolio's bond holdings. Investors who are long bonds can buy CDS protection. So if the bond was paying out 6% per year, if the CDS costs 100 basis points or 1% a year, they're left with a riskless bond position, effectively a government bond return rate, yielding 5% per year. For example, if a CDS spread or cost of protection is trading at 300 basis points, while the equivalent bond maturity yields 8%, and suppose the risk-free rate is 4%, the CDS is trading too cheap, and investors could buy the bond, buy the CDS protection, and earn an arbitrage profit of 1% per year. Credit market participants have created indices to track credit default swap spread movements. This can be a good real-time metric of risk in the bond markets. The most followed CDS index for US credit quality is the CDX. In Europe, it's the iTraxx. A key feature of CDS valuation are the probabilities of default implied in their pricing. These can be backed out of market prices of the CDS and are called implied probabilities of default. The CDS market has been rapidly growing since the 1990s, and CDS are important tools for managing risks. However, they have come under significant regulatory scrutiny since banks and insurers held excessively large CDS positions that went sour in the financial crisis of 2007-2008. A CDS insurance buyer might be paying just 1 to 2% per year on a $10 million notional. That's approximately the smallest that anyone would trade, equating to just $100,000 to $200,000, but standing to gain $10 million in a credit event. If you pay this for half a year and then the reference entity defaults, you receive an extremely skewed payoff profile. Therefore, buyers worry considerably about counterparty risk in the CDS market. Regulatory pressure has increased on trading CDS in a more transparent manner. The goal is to shift them from opaque OTC transactions onto exchanges and clearinghouses and to reduce counterparty risk. Many traders in the CDS market do not favor an electronically listed and cleared CDS market, since the increased transparency is usually accompanied by reduced bid-ask spreads for their market-making activities. In 2009, the Dodd-Frank Wall Street Reform and Consumer Protection Act mandated that swaps be regulated by the Commodity Futures Trading Commission, or CFTC. It specifically required a clearinghouse to be set up to trade and fairly price swaps. In the United States, ICE Clear Credit and the CME Group are two central counterparties for CDS. Contrary to swaps tied to indexes, regulators haven't yet pushed most single-name credit swaps through central clearinghouses. Instead, they've largely remained bilateral transactions between dealers and clients, requiring higher capital charges under banking regulations. This has led investment banks to withdraw from the market and made trading credit default swaps more expensive. So what are the implications of CDS? Well, some market participants argue that CDS allowed lenders to issue loans without adequately assessing credit quality, since lenders can sell all of the risks onto other investors and avoid credit evaluation and monitoring costs. The reduction in credit assessment should reduce borrowing costs, as traditionally those evaluation and monitoring costs were passed through to the borrowers in the form of higher interest rates. Repackaging and distributing risk is superior in many ways in that more investors have access to the returns of a variety of credit issuers than they previously would, and risks are spread out to more investors rather than concentrated within one financial institution. However, risk assessment might best be done by a lender in advance of a loan being made. The lender is in a unique position of access to bond issuers, senior management, and can request documentation that small investors would struggle to attain. In a world with credit hedging, fewer difficult questions are asked of borrowers, and that's a problem. Criticisms of CDS. Critics of the CDS market have claimed that it has been allowed to become too large without proper regulation, and that the CDS market has no transparency. Furthermore, there have been claims that CDS exacerbated the 2008 global financial crisis by hastening the demise of companies such as Lehman Brothers and AIG. Financial commentators have argued that insurance markets where neither party has an insurable interest can lead to suboptimal social behavior. There have been cases where bondholders, who also own large amounts of CDS, might aim to push for the company to enter bankruptcy in order to benefit from the credit event with their CDS. Many argue that purchasing insurance when you lack an insurable interest should be regulated and potentially made illegal. CDS can give investors a false sense of security. For example, in 2012, the Greek government required bondholders to take a 75% loss on their holdings. CDS were not deemed to have experienced a credit event because the write-down was mandated by Greek law. The realization that CDS provided no protection could have destroyed the CDS market, because borrowers like Greece could intentionally circumvent the CDS payout. However, after some delay, the International Swaps and Derivatives Association ruled that these CDS should be considered to have experienced a credit event, and the buyers of protection on Greek debt had to be paid. CDS are usually traded as a 5-year contract, and there's very little liquidity in off-the-run CDS. Traders might buy a CDS contract and after a few weeks or months wish to sell it. They might do this by entering into a new offsetting 5-year contract, which mostly hedges their exposure, but will leave some non-overlapping risk when the first contract rolls off and the other still has some time left on it. Regulations passed since the G20 2009 Pittsburgh Agreement require portfolio compression from certain market participants, which can be achieved through simultaneous novation, cancellation, and/or amendment of multiple contracts. This is often facilitated through settlement of a cash-out sum. So, how do we price CDS? There are two main approaches to pricing CDS contracts: the probability model and the no arbitrage approach. The probability model of pricing CDS takes the present value of the expected cash flows weighted by the probability of non-default. The inputs to this model are the premiums paid, the expected recovery rate in the event of a default, the credit curve of the reference entity, and the LIBOR curve in the market. For simplicity, the initial modeling is done assuming that a default, should it occur, happens only on premium payment dates. In practice, if a default occurs between payment dates, the buyer will owe a prorated premium to the CDS seller. A tree can be drawn of all of the possible outcomes or paths of the investment, where at each premium node the reference entity defaults or not, and probabilities are assigned at each juncture to the events. A present value is taken of the probability-weighted cash flow outcomes. The probabilities of non-default at each juncture are calculated based on the credit spread curve of the underlying reference entity. The no arbitrage approach to pricing CDS. The no arbitrage model assumes that there's no risk-free arbitrage and assumes no counterparty risk of the protection seller. Under this model, a CDS's price can be backed out of bond and swap spreads over a risk-free benchmark such as LIBOR or US Treasuries. Suppose that a bond has a spread of 200 basis points over LIBOR, and that the swap spread, the spread paid by the fixed rate payer over the risk-free rate, is 60 basis points. This means that the CDS contract should trade at 140 basis points, otherwise an arbitrage would exist. However, there are sometimes reasons that in practice this tight pricing relationship does not hold, and in these situations the difference between the no arbitrage price and the live trading price is called the basis. So that's it for today on CDS. All of these videos are based on my book, which is linked to in the description below. Don't forget to click on the like button if you found this video helpful, and subscribe if you'd like to see more videos like this. Tune in tomorrow when we'll learn all about CDOs. See you then. Bye.